Welcome, ladies and gentlemen, to this presentation on impact investing, characteristics and problems. My name is Marco Menichetti. I am a professor in banking and financial management at University of Liechtenstein. We start with the topic Introduction to Impact Investing. In the following section, we compare impact investing with other sustainable investment strategies. Section 3 is on impact investing market characteristics. And after that, we will talk on impact measurement and then discuss how to overcome the challenges of impact investing. Section 5 is a literature review based on 3 papers. The presentation will end with a reference list. Well, this topic, impact investing, is a very important topic, and you will learn over this chapter what the important issues are and why impact investing is so important. Who are impact investors? Impact investors try to achieve a measurable social and environmental impact additional to financial return. Impact investing can help to rebuild the world into a more inclusive, more resilient, and more sustainable future. The interest in impact is increasing. In 2010, only 24 institutions answered to a survey of GIIN, and in 2020, insights from nearly 300 of the world's leading impact investors have been collected. The impact investing industry is very diverse in geography, asset classes, and approach. The market is also growing in depth and sophistication. Nearly 7 in 10 respondents believe the impact investing market is growing steadily. We not only notice strong growth, but also an increasing sophistication in terms of market evolution, indicators of market growth, motivation for making impact investments, and growth of realized asset returns. So let us come to the next slide. Despite the existence of heterogeneous definitions, they are similar in their core elements. GIIN in 2022 defines impact in the following way. Impact investments are investments made with the intention to generate positive, measurable social and environmental impact alongside a financial return. And as an example, we refer to Wettstein et al. In 2019, who define the following 4 core elements. As you see in that table, there is achieving financial return at least, this is from capital preservation up to market return. Then we have intentionality. The investor pursues an intentional effort to achieve social and environmental impact. And then we have impact measurement, which means impact should be accessible and measurable and then also reportable. Impact creation at the end, and only this investment generates positive social or environmental impact. It's important to emphasize that intentionality, impact measurement, and creation form the significant difference to all other sustainable investment strategies and cause the higher transformation speed for our transformation into a sustainable society. On the next slide, we discuss the terms investor impact and company impact. An investor impact means impact caused by investment activities of investors. Company impact is a result of company activities leading to a sustainable change in the world. The figure in the lower part explains a bit better the difference between both. If investors change company impact because of additional money, this impact has to be added to company impact, which would have happened even without investors' additional activity. And I repeat it another time. Impact investments are done with the intention to generate positive, measurable, social and or environmental impact alongside a financial return. This can be across asset classes in both emerging and developed markets and target a range of returns from below market return to market rate, depending on the investor's strategic goals. Let us talk on some risk and capital definitions which are necessary. Climate physical risk. These are risks from increasing temperatures, rising sea levels and changing weather patterns like drought, flood, storms and so on. Then the second is climate transition risk. These are post-transaction risks from unplanned and abrupt changes to businesses or assets, such as changes in policies, shifts to low carbon technologies or other liabilities. And catalytic capital. What is that? These are debt or equity or guarantees and other investments that accept disproportionate risk and or concessionary returns relative to conventional investments in order to generate positive impact and enable third-party investments that otherwise would not be possible. This slide lists the contributors of portfolio risk. I will not comment all these risks, as you probably know traditional risks already. The risks here are business model execution and management risks, country and currency risks, ESG risks, and this is new. These are risks derived from non-compliance with E or S or G criteria. And then financing risks, you know that already, and then impact risks. The possibility that the investment does not achieve the desired social or environmental benefit. And then we have liquidity and exit risk, we have macroeconomic risk, we have market demand and competition risk, and we have perception and reputational risks. This slide lists contributors of impact risk. These are evidence risk. This is the probability that the evidence on which the strategy is based is faulty, and so the expected impact will not occur. Then we have external risk. the probability that external factors disrupt the ability to deliver the expected impact. Execution risk. This is the probability that activities are not delivered as planned and do not result in the desired output. Stakeholder participation risk. This is the probability that expectations or experiences of stakeholders are misunderstood or not taken into account, reducing their participation or uptake. Drop-off risk. The probability that the expected impact does not endure. Unexpected impact risk is the probability that unexpected positive or negative impact may be experienced by people and/or planet. Efficiency risk, the probability that the expected impact could have been achieved with fewer resources or at lower cost. And as the last point, contribution risk, the risk that an investment leads to the same or worse effect compared to what would otherwise have occurred. All right, we return to our table of contents and continue with the next section titled Comparing Impact Investments with Other Sustainable Investment Strategies. Well, this figure gives us a visualized idea where we stand with impact investing within the continuum, starting at traditional investing and ending at philanthropy. In the first full line, we start with the left, at the left, with traditional investing, which goes over to responsible, sustainable, thematic, and impact-first investing, and finally leads to philanthropy. In the section below that you find competitive returns, ESG risk management, ESG opportunities, and high impact solutions. And below that, you find the specification into finance only to the left, impact only at the right, and in the middle, new paradigm. So you find that in between. Please check the figure and the examples on your own to understand the terminology offered. We still refer to the last figure which we discussed just a minute ago. You should understand the differences between traditional finance and new paradigm, which is sustainable finance, versus philanthropy. Traditional finance only looks at financial goals. New paradigm tries to combine financial with sustainable goals. And philanthropy is not searching for a reasonable combination and only searches for impact. As you can see in the figure, the new paradigm lists 4 sustainable strategies, which are responsible, sustainable, thematic, and impact first. A clear differentiation between them in the literature is very difficult to find. Well, on this slide, we refer to a table from Bush et al. In 2021, which also tries to identify the differences between investment strategies. Please take the time to go through that table on your own. I only want to mention the most apparent differences between ESG screened, ESG managed and impact related investments. ESG screened means the use of ESG criteria in sustainability investment, positive or negative screening, to mitigate ESG related risks. ESG managed assumes a systematic reflection of ESG related risks, includes at least one additional investment strategy, and offers more transparency. And impact related means a stronger contribution to social and environmental solutions with proof of materiality and detailed description on measurement of impact achievements. So we return to our table of contents and go on with the next section titled Impact Market Characteristics. Please go through the two figures on your own and check the details. The upper figure on sustainable investing assets by strategy and region in 2020 shows the disappointingly lowest importance of impact and community investing compared to ESG integration, and showing the highest assets under management for ESG integration. So impact is unimportant. The lower figure shows the proportion of global sustainable investing assets by region in 2020. The most important regions are the US with a part of 48%, followed by Europe. Their stake is 34%, and Japan with 8%. On the next slide, we have a figure on global growth for sustainable investing strategies from 2016 to 2020, delivering worldwide figures on the 7 strategies. Regarding impact investing, the assets under management are quite low, and the growth rate is with 9% relatively low. On the next slide, we can have an eye on regional shares by asset weight in global use of sustainable investment strategies 2020. The impact investing volume of US dollars 353 billion worldwide in 2020 arose to 60% in the US and 30% in Europe. The US is by far the strongest market for impact investing. This table, by a different source, and also delivers different figures, offers more geographical differentiation, and you could check that on your own according to your own interest. On the next slide, we have a table showing growth rates of assets under management in sectors. The highest impact investing levels can be found in sectors energy, financial services, and microfinance. High growth rates can be identified in the sectors WASH, which means water, sanitation, and hygiene. Then also in financial services, in healthcare, food and agriculture, and energy. After having discussed financial market data, we now approach the question, who are the major impact investors? Major groups are fund managers, either for profit or non-for-profit, foundations, development finance institutions, family offices, pension funds, insurance companies, diversified financial institutions, and NGOs, as well as religious institutions. On the following slide, we offer data on target financial returns sought. This is received by the GIIN survey. The big majority, 67% of investors, expect risk-adjusted market rate returns. 18% expect below market rate returns, and 15% expect below market rate returns, but now closer to capital preservation. The last figure here in that section is on motivations for making impact investments. This gives an insight into why investors invest in impact. Let us look at the third highest chosen reasons. Here you read, central to our mission to intentionally pursue impact, or part of our commitment as a responsible investor, or efficient way to meet our impact goals. Please take some additional time and read through the lower weighted reasons. They are also important and give you good insight into the industry. We return to the table of contents, and as you see, our next section is titled Impact Measurement. But, ladies and gentlemen, we stop the presentation for now, and we will proceed exactly here in the second part of this slideshow. So, bye-bye for some seconds or some hours, as you like, but see you soon.